Imagine a world where trillions of dollars pulse through the veins of the global economy, invisible to most regulators, fueling growth yet harboring the seeds of catastrophe. These are the shadow banks, entities that mimic traditional lenders but operate in the twilight zones of finance, wielding immense power without the chains of oversight. They promised efficiency and innovation, but as history shows, their unchecked might can topple empires of wealth overnight. The story begins in the aftermath of World War II, when the financial landscape was rigidly structured around commercial banks, backed by government guarantees and central bank support. But as economies expanded in the 1960s and 1970s, cracks appeared. High inflation eroded the appeal of regulated deposits, prompting investors to seek higher yields elsewhere. Enter the precursors of shadow banking, money market funds, which offered bank-like returns without the regulatory burdens. By the 1980s, deregulation under policies like the Depository Institutions Deregulation and Monetary Control Act in the United States accelerated this shift. Investment banks, hedge funds, and other non-bank intermediaries emerged, transforming short-term funds into long-term loans through complex instruments like repurchase agreements and asset-backed securities. This parallel system grew quietly, driven by the demand for credit beyond what traditional banks could provide, especially in housing and corporate finance. As the 1990s dawned, shadow banking evolved into a behemoth. Entities like broker-dealers funded vast portfolios using overnight repos, essentially short-term loans collateralized by securities. This maturation transformation allowed them to borrow cheap and lend long, mirroring banks but without deposit insurance or liquidity backstops. The Asian financial crisis of 1997 exposed early vulnerabilities as hedge funds like long-term capital management nearly collapsed under leveraged bets, requiring a Federal Reserve-orchestrated bailout. Yet the system expanded unchecked, fueled by globalization and technological advancements in securitization. By the early 2000s, shadow banks were deeply intertwined with the housing boom, originating subprime mortgages and packaging them into securities sold to investors worldwide. This web of interconnectedness amplified risks, turning local real estate bubbles into global threats. The turning point came in 2007, when whispers of trouble in the subprime market escalated into a roar. Shadow banks, reliant on wholesale funding markets, faced a modern bank run. Investors fled repos and commercial paper, starving institutions of liquidity. Lehman Brothers, a quintessential shadow bank, filed for bankruptcy in September 2008, triggering a cascade that froze credit markets and plunged the world into recession. The crisis revealed how shadow banking had inflated the financial system. By 2007, its assets rivaled those of traditional banks, but without safety nets, it amplified shocks. Governments injected trillions of bailouts, not just to banks, but to stabilize the shadows, proving that what lurks unseen can still devastate the visible economy. Diving deeper, shadow banking operates through a chain of credit intermediation. At its core is maturity transformation, taking short-term liabilities, like money market fund shares, and converting them into long-term assets, such as loans or bonds. Credit transformation involves pooling risky loans into seemingly safe securities, distributing risk across the system. Liquidity transformation promises investors easy access to funds, even as underlying assets remain illiquid. This alchemy reduces borrowing costs. Studies show it lowered rates by up to 1% in the pre-crisis era, but it creates mismatches. High leverage, often 30-to-1 or more, magnifies gains and losses. Unlike regulated banks, shadow entities lack capital buffers or lender of last resort access, making them prone to fire sales during stress. Economically, they channel savings into productive investments, but systemically, they foster interconnectedness, where one failure ripples outward. Today, shadow banking is larger than ever. As of 2023, the non-bank financial intermediation sector, encompassing shadow activities, held assets worth approximately $240 trillion globally, according to monitoring by the Financial Stability Board, nearly half of total financial assets, and growing faster than traditional banking. In the United States, hedge funds and private credit firms have surged, filling voids left by post-crisis bank regulations like Dodd-Frank, which tightened capital requirements on lenders. In China and Europe, similar expansions address credit demands amid economic slowdowns. Yet this growth brings perils. Vulnerabilities in money market funds persist, and private debt markets echo pre-2008 excesses. Regulators, through bodies like the IMF and FSB, now monitor these entities more closely, implementing macro-prudential tools to curb systemic risks. Still, the sector's opacity challenges oversight, as seen in recent stresses like the 2020 COVID-19 market turmoil, where central banks again intervened to prevent collapse. In reflection, the hidden power of shadow banks lies in their duality, as engines of innovation that democratize credit, yet as harbingers of instability that demand eternal vigilance. They remind us that finance's shadows are not voids, but mirrors of our ambitions and oversights. As the world navigates an era of rising debt and geopolitical tensions, understanding this parallel realm is not just academic, it's essential for safeguarding the fragile architecture of global prosperity.